Hello traders, the title of the video is Mastering Elliott Rules, Step 4. Have you watched Step 1, 2, and 3? That's very good. Do you want to master the Elliott Rules? Step 4? Alright, my friend, let's get started. I will not repeat myself. I will not talk about what we have discussed in part 1 to 3. This is something new. We will talk about, the Elliott rules that stated that, the first, the third, and the fifth waves can be extended. So you may say, Joe, you talked about Elliott wave extension before. I master Elliott wave extension. Why should I watch this video? Well, the answer to that question is that we want to do deductions from that specific Elliott rule. What can we deduct from the fact that the first, the third, and the fifth Elliott wave can be extended by making a variable deduction, a correct deduction from that specific Elliott rule? We can time the market more accurately. All right, we can make profitable financial market prediction. We can make excellent day trading, swing trading, position trading decision. Even make more rewarding investing decisions. Let's get started. First, third, and fifth wave are multi-wave, and they will be in the direction of the trend. All right. So the rule stated that the first, the third, and the fifth wave can be extended. Why? Now you may say, Joe, you talked about it before. We know why. All right. The reason why the first, the third, and the fifth wave can be extended is because if there is a trend, now let me say in a different way, if, for instance, there is a bullish trend, it means that the market is saturated by the bulls. It also means that the market sentiment is bullish, or the fundamentals are solid, or the sector is booming, or the market itself is bullish. Therefore, we will have more buyers and more people will be more willing to buy that financial instrument in a bullish trend. All right? On the other hand, if the market is bearish, or if you're in a downtrend, the first, the third, and the fifth bearish waves are likely to be extended. Because if the market is bearish, most people, the market is saturated by the bear, and everybody will be looking for any type of excuse to sell in the financial market. Therefore, there will be more demand to sell during a bearish trend when the market sentiment is bearish or when the fundamentals are deteriorating, or if there is a money outflow from that sector into another sector. All right? So we will have an extension of the first, the third, and the fifth wave. Another thing I need to explain to traders is that the first, the third, and the fifth wave are multi-wave. They are in the direction of the trend. And anytime we are in the first, the third, and the fifth wave, we will have more demand to buy in an uptrend and more demand to sell in the bearish market. All right? So we also explain to traders in part 2 of this series of videos is that a correction is referring to us to a normal correction, which should be a minimum. So if, for instance, the first wave is not extended and we have a normal correction, we will expect the third wave to be extended, because if the market is bullish and stays bullish, if the fundamentals are solid, if there is no reason to sell, there will be more demand to buy. Therefore, we expect the third wave to be extended. The third wave will be extended because the second wave, if it is a normal second wave, or if we have a normal correction, is an invitation to participate in the trend. So if you are in an uptrend and we see the second wave, which is a normal second wave, a minimum correction, a normal correction, this is an invitation for other traders to participate in the trend, whether it's bullish or bearish. Therefore, we'll expect an extension of the third wave. The next thing that we will also expect is that if we have a normal fourth wave, if there is a trend, the corrections are usually normal correction. Those corrections are likely to be minimum, a pullback or minimum rally in a downtrend. Now, referring traders back to the step 2, corrective wave, minimum price move is free. It's a minimum pullback. It's a minimum rally in a downtrend. Should be minimum price move. So if we have an impulse move followed by a minimum pullback or a minimum rally in a downtrend, it's an invitation to sell in a downtrend. It's an invitation to buy in an uptrend, because the market is saturated by the bull and there is no reason to sell. There will be more demand to buy, and if we have an accumulation taking place in a third wave after the normal pullback, there is a high chance that the third wave can be extended. Now you have to understand that the rule does not say that the first and the third and the fifth wave must be extended. It did not say that. It says that those waves, those impulse waves in the direction of the trend, are likely to be extended. Those trends have more chance to be extended because there is a trend, there is a demand to buy or sell because of the trend. This trend is established. There is no reason to buy. There is no reason to buy in a downtrend. There is no reason to sell, in an uptrend, because the fundamentals are solid. Therefore, we are likely, not always, no guarantee, that the first, the third, and the fifth wave, will be extended. Now, you have to understand that when we use the word like motive, all right, the root word for the motive is moteur. Moteur. In French, moteur. Am I speaking with my, gorgeous American accent? Moteur, all right? The engine, all right? Moteur as, the engine of the trend. So what we are saying is that the first, the third, and fifth waves are the motor or the engines of the trend. Therefore, if they are the motor or the engine of the trend, we are likely to see an extension. Those three waves are propelling the price. There will be more demand to participate in that trend if there is no reason to do otherwise. We can also deduct that if the first wave is not extended, there is a high chance that the third wave will be extended. We can also deduct, this is the sign for the deduction for mathematicians, deducting something from the Elliott rule in order to focus the market, or deducting something from this specific Elliott rule to make excellent trading or investing decision. Deducting something from this Elliott rule to make excellent trading and investing decision. What we are discussing here will become very, very interesting when we have the first and the second wave, the first and the third wave that are not extended. You will see that. So if you see that the third and the first wave are not extended, as the fifth wave is underway, we will be expecting, not guarantee, all right, don't bank on it, all right. We will be saying that, all right, traders and investors, because the first and the third wave are not extending, according to the Elliott rules, there is a high chance that the fifth wave will be extended. Looking at the current market environment, the S&P 500 is still bullish, is now in the third wave, and the fundamentals are solid. There are more money coming to this sector. There is no reason to sell now. The only thing that can come into our mind, because the first and the third are not extended, the fifth wave will be extended. It become true, though we are talking about all right, though we are talking about the multi-wave. Here it is, we are talking multi-wave from here, first, second, third, fourth, and the fifth wave. You see, from here all the way up here, that is the multi-wave. This is the what we call the trending file that is formed of first, second, third, and fourth and fifth wave. All right. Now, though we are saying that during a multi-wave, this is also true in a corrective wave. Now, because a correction can be a zigzag, yes or no, all right? So a correction going down like this. If you see the correction going down like this, and this is the first wave of any wave, whether impulse wave or corrective wave, will give us a bit of idea where the price is likely to go, as long as the second wave did not come all the way here. So here it is, 1, 2. This is telling us, the first one is telling, the first move is telling us that this move is likely to go down, as long as this one further resistance here, the common central is kaput. Trend or correction will be in the direction of the first move. Here it is. So you will see, that's why you see sometimes the zigzag pattern, you see 1, 2, 3, 4, 5, and then 1, 2, 3. That 1, 2, 3 of the zigzag pattern is also correcting the A part of the zigzag pattern. All right. Because the A part of the zigzag pattern can be extended, the third part of the zigzag pattern also can be extended. Are you getting it? Doesn't matter whether we are talking about multi-wave or corrective wave. Same thing we see for the flat correction, 1, 2, 3. And then 1, 2, 3. And then 1, 2, 3, 4, 5. My friend, do not be surprised to see that the first part of the zigzag pattern can be extended, and also the third part of the first part of the flat correction can be extended, and the C part of the flat correction also can be extended. The general rules of this, what we are discussing here, talking about the first, the third, and the fifth, all right, it has something to do with the minimum price move is free. You understand? Because any first price action, any first price move, all right, in bracket, all right, is an impulse wave. Are you getting it now? Don't get confused. Don't get confused. I'm saying in bracket. In bracket is an impulse wave. So for the zigzag pattern, the A part of the zigzag pattern is an impulse wave of that zigzag pattern. The C part of the zigzag pattern is an impulse wave of the zigzag pattern. All right. So we can know that if we see any first move and the second move did not come at the beginning of the first move, we will say that the third move has a more chance to have the same characteristic than the first, like the first one. Are you getting it now? This is very important. Let me say this again. Anytime you see anything like this, you count something first and second, and the third is underway, understand that third move has a high chance to have the same characteristic, structure, like the first one. Well, if you get that, I'm very happy. Doesn't matter whether you are in a corrective wave or a multi-wave. Anytime you call something first and you call something second, the third move that is underway has a high chance to have the structure of the first one. Now, those who are Christian may understand this. We say, as he was at the beginning, so shall be at the end, isn't it? All right, the Alpha and Omega, the beginning and the end. So that's why we can use the structure of the first wave to forecast the whole multi-wave. It's becoming more. We can go a little bit deeper and deeper. That anytime you see any price move in the financial market, and you recognize that this is the first move, whether it's up or down. That first move, whether it's an impulse wave or a corrective wave, just remember the first move, okay, will determine the following move. But then if we have the second move, which is a contra trend to the first one, we can deduct that the third move is likely to have almost the same structure like the first one. We can deduct again, talking about the multi-way itself, that if the third move also has the structure of the first one, all right, the fifth wave will also have almost the structure of the third. Now, bringing us to what I've said to traders before, I think in the first part of this video, that we are talking about 3, 5, we are talking about first and second. Do you remember that? The first and the second, we highlight that section. And also, we are talking about 3 and 5. Am I making sense to you? Are you getting it? Sometimes, what I've noticed is that you want to communicate something to traders, especially you are recording a video like this, is sometimes it's not the subject itself that is complex, but what is complex here is how you communicate to traders. It's now complex to me personally to help you to duplicate what I'm trying to share with you today. So what I'm saying to you, first wave, and then you see the second wave did not cancel it. If a third move is underway, I'm not saying that the third move will definitely or is guaranteed or is always going to have the structure of the first one, but all I'm saying to you is that the third move has a high chance to have almost the same structure like the first one. If you get that, good. So what I'm saying to you, because we are talking multi-wave, because anytime you see an impulse wave and you see a normal correction, the following impulse wave has a high chance to have the structure of the prior impulse wave. What we are talking about today is not only about the Elliott wave extension, talking about the first, the third, and the fifth wave can be extended, and the bottom line is what can we deduct from that and make excellent trading decisions. All right. So what I'm going to do now, I'll go quickly. Hopefully, that trader who understand a bit about the fractal. So you are here. Okay. Suppose you are here. We are now on the 15-minute time frame. Okay. All right. Okay. So you're on a 15-minute time frame. This was a bearish trend. Oh, I hope I'm making sense today. Otherwise, I'll be very disappointed if I don't. All right. So here it is. Price start going up. Yes or no? So if this is the move that breaks above it. Okay. So now we can call this one like a blah 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 consolidation, and then now here it is. This is the breakout. Yes or no? So suppose you are here. You call this one the first one. Because you are calling this one the first one. Now this is if this is. Repeat, if this is an impulse wave, then you will expect a correction. In normal correction, we expect a minimum correction. Here, it happened to be a minimum correction. All right, what can you deduct from that? Talking about the first, the third, and the fifth wave. So now the third move is underway. What you can do, you can look at the structure of the first move to predict what is likely to happen here. What we can deduct again here is that anytime we see any impulse move, as this one is in place now, if we have any correction after any impulse move, the following impulse move, in order to predict that, we need to look back at the previous, impulse wave. Either this one or this one will help either the first or the third will help us to have a bit of idea how the fifth one will be completed. With that information, you can deduct and focus the market like a pro, making better, excellent decision. Now, I understand, my friend, that for some traders, they may think that, Joe, this is another blah, blah, blah. Do not behave like I did myself at the beginning when I was a new trader, marking video down, doing all kinds of sort of thing in the financial market, all right? Don't do that, okay? Hold it there, hold it. Say, George, I disagree with you, but I'll come back to that. I'll think of it, all right? I'll sleep on it. I'll sleep over it, and I'll come back and tell you exactly what I think. So if this is new to us, don't discount it straight away. That's the best approach. Go around, think of it, work on it, stay away from it for a while, all right? Or maybe unsubscribe for one day and come back the next day, subscribe again, and see whether it makes sense or not. Because it took me some time to come to those conclusions, and this is what I'm sharing with you today. And sometimes you may find something new for the first time. Remember the first time they said that, well. You remember Newton when Newton discovered that, it's not the sun that was rotating around the earth. They would kill people for that. They were killing people for believing that, all right? Is the earth, okay, that is moving around the sun. Before people were believing that it was the sun that was rotating around the earth, that the earth was the center of the universe. So the same approach I want you to adopt today. What I'm sharing to you with you today may not make any sense. Go away, sleep over it, think of it, come back maybe a few months later and let me know what you think. It may not make sense to you today, but try to handle it, not just like a little child, but like a mature person that have done a bit of work before coming to a conclusion. All right. So I hope I have managed to communicate what I want to share with you today, what we can deduct from the Elliott wave rules that stated that the first, the third, and the fifth wave can be extended in a trend. All right. Have I been talking for too long? 21 minutes. All right, let's wrap it up. Okay. So if you have any question or suggestion, feel free to put in the comment section. And in due course, I will be recording another video to answer your specific question. If you think this is an essential tutorial, feel free to share it on Google+, on Twitter, and also on Facebook. If you find this video useful, personally speaking, all right, mark it up. If you think that, George, I'm not convinced with all this deduction, mathematics, fancy word, well, mark it down, and that will put me under pressure to improve my next recording. So that we conclude our discussion today about mastering Elliott wave rules, step 4. I need to remind traders that this is also the last video in this series of videos that we call mastering Elliott wave rule, step 1 to 4. My recommendation to traders is to take each step one at a time, to try to understand what I'm trying to communicate, and most importantly, once one has mastered it, one may use a demo account, practice, before going live. That's the best approach. All right. As always, put the comment and questions in the comment section, and I will come back to you in due course. I hope I've managed to communicate everything I need to do in this series of video, and I hope you have found it useful, to become a better or more advanced Elliott wave trader. So this will conclude our discussion, this series of video about mastering Elliott wave rules, step 1 to 4. This is step 4, end of step 4. Happy trading to you all, and speak to you soon. We are the TSTW24 traders talking about mastering Elliott wave rules, step 4.